hello to our customer, to our partners, to our business-related investors. We would like to share our view on macro and our view on the markets globally with you. Today, we have Andreas Bickel, CIO of Blackfort Capital, former head of portfolio management of such companies as Goldman Sachs Switzerland, Deutsche Asset Group Switzerland, Rothschild Bank Switzerland, is now sharing his view with friends of Blackfort, and I'm looking forward to hand over to Andreas and hear from him his opinion on recent events in the macrosphere and in different countries, especially now after the corona outbreak. We have a very intense news flow and very volatile markets, so we are glad to hear some feedback on what's going on the markets from such a specialist. Thank you very much for joining us. You can watch us on YouTube and also join us on LinkedIn. And of course, we are willing to answer all your questions. You can post them directly on our website or address them in our regular conferences directly via chat. So I would like to hand over to Andreas Bickel, CIO of Blackfort Capital.
Thank you, Gleb, for the introduction. So today's macro call is basically giving you an update on the outlook of the economy, which unfortunately has to be more concentrate on recent developments on COVID-19. I found a new topic which I want to share with you. It's called balance sheet recession and Japanification. What it means partially is that the Fed rates are at zero. However, markets tell us they might stay at zero for much longer than the Fed tells us. Until 2024 is the question. Euphoria is back. Tech stocks and US market in general, but driven by FANG Plus, have risen too much too far. Therefore, we have really concentrate on that and what it means. Gold keeps shining. We keep liking gold to a lesser extent, mining given our equity outlook. Last but not least, the US dollar has over the last 2 weeks weakened as expected because of the risk on mode. So the main problem with the COVID breakout at the moment is, besides the US, Brazil, Russia, and India, and to a lesser extent, Peru. The problem here is basically that we don't see a slowdown of the first wave. By the contrary, we have seen an acceleration of the first wave. And that's in two ways scary, because the first wave should first flatten, and then you should try to avoid the second wave. However, we have never been able to stop it in these mentioned countries here, and the second wave might come in autumn. To make matters worse, California, which is the 5th biggest economy of the world, bigger than, for instance, India, has a second partial lockdown. This has consequences on the GDP outlook of the United States. I found this morning this map here. This is a kind of analysis which states are having what they call a red zone. Red zone means more than 200 new cases per 100,000 inhabitants. This is getting bigger and bigger, getting out of control. There is now a fight between Dr. Fauci and Mr. Trump. This is definitely not solution driven. It is definitely not going to find a way how they can handle and pulling down the case numbers. Texas, as an example, Texas actually is bigger than the whole Germany, is having a second lockdown. So everything is really close there, is even more than in California. That will drag, obviously, the outlook of GDP for the US. People were asked what is the impact of these new cases of COVID. And obviously, one doesn't expect a double dip recession, that's the good news. However, one expects a significant slowdown of the actual recovery, which was probably U-shaped. As you can see from this survey, the double dip recession scenario is at the very low end. However, the latest fund manager survey by the Bank of America and Merrill Lynch shows that on one hand, the U-shape is the most likely outcome, but the W shape has gained more traction while V-shape has lost momentum. So overall, the American fund managers are extremely cautious, while at the same time they have increased risk because they had to follow the rally driven by retail investors, which is also a new phenomenon. Normally, markets are dominated by institutional investors. However, this rally since March was heavily driven by retail investors, by platforms like Robinhood or online trading like Charles Schwab, E-Trade, etc. If we look at the bond market and trying to get a hint what happens with the outlook of the US economy, first of all, we are in a red shaded area. That means a recession. Second, the yield curve got slightly flatter. That means the bond market is expecting a certain slowdown, which we tend to agree. In the Eurozone, there is definitely a recovery on a very, very slow pace. As you can see here, this is a kind of proxy for GDP development. You see the selling of used cars, not new cars, but used cars. And basically, this looks to us as a U-shaped recovery, or another confirmation that the path to recovery is rather slow. Similar can be said if you look at Germany, truck traffic, truck who transport goods and services. Yes, there is a recovery. However, we are still not where we have been before the crisis broke out. Not shown here, retail sales are aggregated on the levels we have seen before the crisis. However, the split is a bit unusual or corona-driven. It was more on the online channels than on the physical shops. But we will see that later on in the case of China. So also here, it looks rather that the largest European economy is in a U-shaped recovery, but not in a slowdown. And the COVID cases are under control. The partial lockdowns which were done over the last 6 weeks have gone. So at the moment, besides you have to wear masks in shops, Germany is on the path of recovery. If you look at PMIs, this data is from the beginning of the month. Next week there will be new ones. You see that most economies, starting with the US, that's the highest level, continuing with China, there is definitely an expectation of a strong recovery. However, when the US data was taken, the lockdown of California, the partial lockdown, and also the lockdown of Texas was not yet in the news, so it was not part of this survey. Nevertheless, we can see there is definitely recovery. Also shown here, Germany in orange and in green, the UK. What is also important is the level. We are below 50, below the growth area. You have two ways to interpret that. One is the slope. The slope is steep. It is rising. That's my take. Or you can say we are still in the contraction area below the 50 area. That's rather the take of economists like the ones from the OECD, from the IMF or the World Bank. They all have published over the last 8 weeks economic outlook, which are extremely bleak. Some of them are even talking of a W recovery / a double dip recession, which is not our case. We are still in the camp of U-shape, and in some areas, like for instance China, it is probably rather a weak V-shape. The US outlook for PMI, as I said, next week there will be the flash data, and at the end of the month, the ISM and the market data. More strength is expected. The Fed Beige Book, which was published this week, painted exactly the same picture. There is an acceleration of growth, however, on a lower pace than expected 1 month ago. So it looks rather U-shaped than V-shaped. And in that data, the Texas and California lockdown was already implemented or used. This is an interesting chart I found from CITIC, broker and research house, which is mainly covering Asia. The key message is global earnings revisions are upwards, which shouldn't be a big surprise given the sharp drop we have seen in March and April. We are expecting for Q4 similar figures than before, however, with a lot of uncertainty. You see as well the PMI, here the US PMI is indicating a similar picture like before, and the key open point is what is going on or will go on with US Treasuries. They didn't make any statements about it. If you believe in correlation, it should go up / the yield should go higher. However, we would argue that this will not happen for 2 reasons. First, the Fed is controlling to a certain degree the yield curve and is discussing to control it even officially. And second, we believe that we are in a balance sheet recession, and in such an environment, yield cannot rise unless there is huge fiscal stimulus, and we are at least 24 months down the road once fiscal stimulus has started. The big surprise was this week, China. First the export figures, but yesterday it came the big boom. Q2 GDP year-over-year change plus 3.2%. It was not flat, it was not minus, it was plus 3.2%. Potential is probably around 5.5 to 6.5. Of course, we are not there yet. However, this is amazing given that they had the lockdown in Q1 and only started in May partially, and then later on a bit more pronounced to open the economy. So the economy path for Asia and in general is probably for most countries rather V-shaped, maybe with the exception of Japan, where there is another lockdown and the cases of COVID are rising. But definitely for countries around China, it looks pretty good in terms of economic and opening and also controlling the further spread of the virus. Not everything is gold or which is shining in China. You see here total aggregated retail sales. They were slightly down. However, they were much more up than expected compared to forecasts. But there is a flip or a side of this story, or there is a shift, if you will, from the physical stops to online retail sales. China has addressed this issue. They allow now pop-up markets in cities, which were forbidden for at least 10 years, to give shop owners the possibility to sell their goods in an open space, as the frequency in physical stores is extremely limited. Similar in Europe, by the way. But you can see that also from this side, the consumer is starting to come back in China, and we are getting closer to the pre-crisis level. The key question stays, will we see something like here on the left-hand side, a deep V-shaped recession? I would say yes, we are in that. However, will we see a strong rebound? Morgan Stanley, BlackRock, and Goldman Sachs are of the opinion that next year in Q4, the global GDP level here shown G10 on the left-hand side will reach the pre-crisis level and even exceed, while in 2008 it took almost double the length. This is unprecedented. It would be one of the fastest recovery in history, as you can see on the right-hand side. This is the number of weeks until the S&P earnings have fully recovered. It has to be seen, this data is roughly 6 weeks old, or this forecast, so I would argue that we are back to the forecast of Morgan Stanley, that at the end of next year we probably are close to levels before the crisis. Also, this would then rather mean U-shape for the US and V-shape for China. But with these two economies, we have roughly covered 50% of global growth. Eurozone, I already talked about. It is probably U-shaped and no double dip. And in the UK, a very similar picture. And with that, we are already at more than 70% of global growth. Therefore, I would definitely argue that there is growth and we are in a recession and markets are pricing in that. However, that we will see in a minute, probably the FANG Plus area has gone too far, too fast. The biggest problem is this. You probably have read about Japanification. That means that the government bond yields are converting towards zero. In some areas, Germany, Japan, we are at zero or slightly below for the 10-year yield. Switzerland, small country, but the currency is quite a big part of the FX market, is as well below zero. And the UK is close to it, and the 10-year in the US is roughly at 60 bips and probably falling further. The key question is how we get out of this. And I found an interesting analysis of Nomura Research Institute. Basically, what they are claiming on the experience of Japan, if you want to end this kind of situation and you want to accelerate growth, you have to stimulate the economy with fiscal and not with monetary stimulus. And if you stop it too early, like Japan did roughly 10 years ago, you fall immediately back into recession and into negative yields and in disinflation or scenario. The good news is that at the moment in Western world, we see fiscal stimulus. Here shown a global chart, global debt to GDP in percentage. You see from roughly 32% to 34% within a very, very short period of time. This is on good news if you believe in the balance sheet recession and the way to repair it. Obviously, if you are the IMF, they rather want you to save money, to do the austerity policy, but this would definitely destroy the weak recovery we see at the moment. To my surprise, the Eurozone is still on track to implement a rescue fund. This rescue fund has or will have a huge impact on budget deficit, and you see it here. So all the main or the larger areas and the aggregated area you see this year between 8 and 13% debt to GDP growth, so more debts, and even next year we see a budget deficit, which I would argue, given the starting point, this is the only way out of this low yield environment. The risk to this is that we will end it too early. Yesterday, the ECB already has announced that their monetary stimulus might end next year. And monetary stimulus is not the solution to the problem. However, if the ECB stops it, and the impact on governments probably will be that they will start thinking of how to repair their balance sheets / how to save money, and that would then be definitely be a risk that we get a second hit on the economic side. Here you see in this red square the planned EU recovery fund. There's a lot of disharmony among the members, especially Italy has publicly announced we are too big to fail. Immediately, Netherlands and Austria, who are the net payer apart from Germany, have answered this is almost blackmailing, although they know that the fact is probably true. However, so far, the European Constitution forbids that there is a direct financing and especially fiscal stimulus and public debt from the European Union. Over this weekend, there will be the summit, and it is expected that some kind of rescue fund will be announced. And with 750 billion, this would put the stimulus of the Eurozone above the US and above the UK. In the US, we still have the discussion of the fifth fiscal packages in the parliaments. Also, probably you have read, there is a risk of fiscal cliff because the help for unemployed people might come to an end at the end of August, and then suddenly you don't get $600 every week anymore. The $600 were more than most people earn. So this package, which is discussed now, is that the aid for unemployed people will continue, but only between $200 to $400 a week and not at $600 a week, which still would be a good case. And the US could definitely avoid that they get a double dip, even if the corona situation is still not solved. Japanification, if you read that, you have to think it to the end. The line at the top is the Bank of Japan, the balance sheet as percentage of GDP. It is definitely huge. Look where the other central banks are. Suddenly the Fed and the Bank of England look very, very modest if you look at this. And to my surprise, the European Central Bank has already quite a high debt burden which they carry on. But if that continues, expect more. Although I hope strongly that the impact will be on states and not on central banks. What is hard to see on this chart, the Federal Reserve has over the last 4 weeks a kind of stopped buying bonds. You see there a flat line, and this was going hand in hand with some more market volatility on the equity side, and net the US equity market haven't risen since that started. The key question here is what will going on next with the 10-year Treasury yield. Given the outlook, given the corona situation, it is quite likely that we will see lower levels than the 0.6% where we are now. This is all data dependent, and it's a bit of psychology. However, the yields are here to stay on this low level for a very, very long time. You see this here. The Fed fund futures, which obviously is at the short end, but the forecast from the market is that we see at least for 36 months rates at zero, while the Fed told us they are going to stay at zero until 2022. This basically means the market expects that it will be until 2023 or even 2024. And this is definitely a long period of time. Will support risky assets, will create bubbles most likely, but key will be that this is accompanied by further fiscal stimulus. If not, we will continue to see low rates, a strike of borrowers, a strike of investments, and no chance that the yield will go up and or inflation will pick up. The next topic is a bit more scary. Those who follow us regularly know that I was a bull since March, since the crash. However, I'm now cautious. Underneath, you see the optimism index 3 months average, and this has reached almost level of the dot-com bubble. and you see above the line of the Nasdaq, which I will show in a minute in another way, you see the strong spike. And I would definitely argue this is too far. Too far means it's roughly 40% above the 200-day moving average. And every time that happens, normally a correction consolidation was around the corner. What I've mentioned before, this strong rise of indices is driven by FANGs. Here only FANGs, not FANG Plus, and this is the Wilshire 5000 market index. This index used to have around 5,000 stocks in it. Nowadays, we are roughly at 3,500 quoted stocks in the States. However, 5 of them, the FANGs, you see them there, Apple, Microsoft, Amazon, Google, and Facebook, they are more than 20% of the index. And they have pushed up even this broad index, mostly driven by retail buying in these FANG stocks. This reminds me actually something I have seen in 1999. On the right-hand side, you see the spike of the Amazon price in 1998 to 1999. But on the left-hand side, you see the actual move of Tesla at FANG Plus stocks. This definitely looks like exuberance. But look what happened in the year 2000 to Amazon. It went from roughly 90 down to 45, up again to 105, down again and stayed there in the low 40s, only to go up above 85, a little correction in autumn, and then it spiked up to 106. And then we all know what happened afterwards. There were the 3 years of the long dot-com bubble burst. What it means for actual, well, I would expect volatility to pick up. So if you go back 1 second, you see the huge volatility in 1991 and the first spike, like we see in Tesla, Amazon had. And why? Well, first of all, given this price move, a counter move has to happen. Yesterday we saw Netflix after the earnings, it went down immediately 15% and closed down roughly 9.5%. This probably will happen to this FANG Plus complex, and we have the election in front of us, the US election. You see that at the moment Mr. Biden is roughly 15% ahead of Trump. I have seen yesterday an interesting podcast about the election from Neuberger Berman. Basically what they tell is that Mr. Trump has a lot of other, let's call it arrows in his pocket, and he will shoot at Mr. Biden in various ways. He will also have more rhetoric against China, maybe the Eurozone, so tariffs, talks. Now he has his talk with Mr. Fauci, so Corona talk. But they believe it will be a very close race, although at the moment it looks like that Biden has already won. So it has to be seen, but forward looking, I definitely expect more volatility over the summer and in particular in September, October before the election. To finish the Amazon story, look at the left-hand side. You see this volatility spike in the long term until recently. Yes, it was a percentage decrease, which is large. And if you look at the right-hand side, the spike up, it is very similar in percentage. So the Amazon chart is roughly 40% above its 200-day average, similar spike like in 1999. Therefore, I would expect a correction of that. And this unfortunately holds true also for broader index like the S&P 500, obviously for the Nasdaq, and also the Wilshire we have 5,000 we have seen before. So I would hope that we see a pause of the rally in the FANGs, or a consolidation, not a crash. But the index can then only stay up if we see a second catch-up rally in small caps. We have seen that in May for a short period of time. It was addressed in this call. We have seen that over the last 2 trading days. That's at the end of this chart. However, the gap is big, and if there is no sector rotation towards small caps or cyclicals or value stocks, the volatility will be higher, and there is definitely a consolidation ahead of us given the strong rise of the FANG complex. So the key question obviously is how this is going to continue. Will there be just a consolidation or a flash crash, or will this bull market, as you can see here, which lasted for roughly more than 10.5 years, be stopped? For those who are a bit older, you might remember from 82 till the year 2000, there was a tremendous rally. However, if you look at the chart, you see that there were two intervals. One was in 1987 and one in 1998. In both cases, we had a sharp drop in a very, very short period of time, but then a continuation of the rally. In one case, in particular in 87, the rally lasted for more than 13 years. In 1998, so during the dot-com bubble, the first part of it, the rally continued as well, however, only for roughly 2 years, and we saw what is now known as irrational exuberance. So my educated guess is that this rally is not completely over, but we must see a pullback. This is a kind of, what shall I say, no-brainer statement. I expect a consolidation over the summer, and if you look at history tells us July is okay. We are in July. We are up between 3 and 6% so far. However, August and September are quite bad months, and actually September is the worst month of all on average. Although the larger crash like 87 and 29 occurred in October. But if you look at the average performance, September is definitely the worst one. Also from this angle, there is a quite high likelihood that we will see a correction over the summer. Also, if you just look at charts, we have closed the gap which was open since March, and we are now at the upper trading range, but away from the all-time high. Nobody can know the future, but if I see this chart was not done by me. Guess what? A lot of people paint the same chart. So also from that angle, there is probably selling pressure at the levels we have seen, and yesterday was a good example. There was selling pressure during the trading session before the Netflix figures, and in the after selling there was more pressure. On the other hand, we see banks, and as we speak, I've just seen that BlackRock has reported a huge beat. BlackRock is up, financial stocks are up, but the tech take a break. This is good for my theory, or for my hope rather, that there will be a rotation towards other sectors. What will be over the next 10 years? Well, my educated guess is 4 to 6%. Guess what? This is the estimate of Goldman Sachs. They expect roughly 6% nominal, after inflation probably 4%. That's what we have to live with, a new normal. If you come from the area of Schiller PE, they are roughly at 28 to 30, and also that means forward-looking returns are below 5% in real term. Therefore, forward-looking, there is definitely still return, but much lower on the equity side. And if there is still the relationship like in the past, the return on the investment grade corporate bond side and government bond side must be much lower. So it is definitely still the case that equities are their place to be, but expect less return and more volatility. For the time being, we prefer, in particular over the summer, corporate bonds, global corporate bonds in the lower investment grade and higher non-investment grade area globally in dollars. And you can see that the spreads have tightened, but there is still room for further tightening. It is also interesting that over the last 3-4 weeks, we see a sideways channel similar to the equities, actually. So you can also see that corporate high yields are another way of playing equities, but with a kind of safety net. If you choose them with a good balance sheet, you get a coupon, and one day, most likely, you get the nominal amount back. So therefore, over the summer, definitely in relative term, we prefer high-yielding bonds, probably first emerging market hard currency before US high yield, but both look attractive to us. Here I have shown you the development of prices of three bond indices, and if I would have put S&P against it, the shape is exactly the same. The only difference is the magnitude. However, if you see, for instance, the white line, which is US corporate high yielding, they went from roughly 105 to 90 down. So this was a tremendous sell-off of more than 15%. In the meantime, however, and that's the point, we are not back to where we have been, but we are maybe down 2 to 5%. Compared to the high level in March, which was actually the all-time high of these indices. So we continue to expect these price levels, total return indices, to go up. Therefore, our relative call, like 2 weeks ago, is more for corporate bonds than for US equities. 2 weeks ago and 4 weeks ago, we were told, and the graphic shows it here, there is an outflow out of money market products and an inflow into equities. If I look at this graph, well, equities, the light blue line, it is really difficult to see an inflow. If I look at corporate bonds, yes, definitely there was an inflow, and there was also a little inflow into government bonds. But over the last 2 weeks, look at the spike in money market products. Knowing that across the globe you get close to zero return before inflation in some areas, in particular in euros, in yens, in Swisses, you get even negative yields. People keep piling up cash. There is a strike of borrowers, like I said before. Or if I can reuse the Japanification process, we have a balance sheet problem, and the balance sheet recession must be solved. It can only be solved with fiscal stimulus, and that's what's starting. Let's hope that it will last more than just 12 months. 24 months, according to the experience in Japan, is the shortest period that we have a positive impact. Obviously, there is always a place where you can hide, and we keep telling you that although there is a certain volatility, gold has a certain protection in the portfolio. Last time we were roughly at $1,750 per ounce. Now we are roughly at 1,800. This is the spot price. The future price is slightly higher. Therefore, market participants expect even higher gold prices over the coming months. And some already talk of 2,000 over the next 12 months, and others keep even the bearish outlook, Japanification, as a starting point, that we might see 2,500 to 3,000 an ounce price. I don't know where it will end, but definitely if you have too much cash or paying negative yields in banks, you might consider park some money in gold. I have shown you here the first 3 lines. A gold ETF in dollar, that's the third one, was up 19%, in euro 17%, and in Swissy 15%. So if you have Swiss francs or euro, there are instruments with physical gold in the background where you can park your money and you don't pay the negative interest of the banks. Or you see as well, dollar 19 and euro or Swissy less return. So the dollar has definitely weakened, which is also supportive for gold, which normally is measured in dollar, but gold is rather a currency And as you can see, you can obviously buy them in other currencies like Swiss, euros, also pounds. If you want to speculate, which we would rather not recommend that for the time being, you can see here free gold ETFs, a broader one in the US, that's the GDX, or a junior gold miner, and also a global one. They all have risen more than 25%, up to 30 year to date, and since the low, even much stronger. However, if there is an equity consolidation, we would rather recommend not to hold them for the time being, because it is quite likely that gold mining shares will fall down in tandem with equity markets and might decouple for a short period of time from the gold price. Last but not least, there was 4 weeks ago a kind of risk on mode. You have seen a strengthening of the dollar index here, measured by the DXY index. However, over the last 2 weeks, we have seen a consolidation of equities, a partially risk-off market, and immediately the dollar starts weakening. This is expected to continue. It can short term anytime bounce, but if that is going to continue, it might definitely support the economy in emerging markets, and it probably will push up gold measured in dollars. With that, I'm coming to the end. So the most likely scenario is a consolidation over the summer, probably with high volatility. The Fed keeps protecting US assets. Similar can be said from the Bank of England, from the ECB, or the Bank of Japan. Different to 4 weeks, 6 weeks ago, we think US equities are overbought. Therefore, a correction should happen or can happen anytime. Asian equities, maybe with the exception of China A shares, have also rallied, but are not so overvalued, and the situation looks slightly more attractive to us. We would therefore recommend building up equity exposure over coming months. You probably don't have to hurry. Maybe we see a low in September, maybe this in August, maybe it's in October. But I would argue from the starting point today, there is room for at least a small pullback. We continue to like bonds, corporate bonds. We tried to choose them with strong balance sheets, given that we are in the double B areas mostly. It is with the restriction that double B bonds have to a certain degree less good quality than investment grade bonds. Nevertheless, in this double B bucket, they are interesting companies, our fallen angels. I give you 2 examples. These are not recommendations. These are just examples of fallen angels. So Boeing or Ford are 2 of them. We also like emerging market corporates. Given that the US dollar is weakening, these economies are supported, and they offer interesting yields. Gold, as I've said just before, is most likely to continue to go up. Real assets are definitely good in such an environment, but it is extremely difficult to implement that. Some examples of goods which have gone up tremendously are watches, art, or old timers. I could also add palladium, which is the best performing metal. But this is rather speculative, and it's extremely difficult to time, to store it, and to take care of it, because watches, they need from time to time a revision. Art needs to be collected and put in a proper way with the right temperature, etc., etc. Overall, this hasn't changed. By the contrary, it got worse. Assets are expensive. In particular, fund stocks are extremely expensive. Equities, unfortunately, will stay over the coming years the place to be, but for the time being, there's no rush to run into it. Balance sheet recession. I hope that this theory, which comes from Japan, gets spread around and that governments keep on with spending more fiscal stimulus. We do not need more monetary stimulus. The next point is here for quite a while. The fifth stimulus package is pending in both US parliaments. We are getting closer to it, but the stimulus will be changed. At least that's the latest reading. It's changed in a way that the support for unemployed people will probably continue, but at a lower, more reasonable levels. All this stimulus has already created a certain melt-up, but I don't think it's finished. I have shown you the example of Tesla and Amazon in the past, so there is probably more room for exuberance. In the US, there is still the risk that in 2021 there is inflation, although that might even be a good thing because the debt to GDP ratio has to come down in real terms, and I'm not so sure, or I would rather add, I'm pretty sure that the Americans won't do it with savings. They definitely need to inflate it away. Last but not least, also this is unchanged, don't underestimate the willingness of the American politicians and monetary members of the Fed members to stimulate. So with that, I come to the end. I thank you very much for watching our bi-weekly call and hope you will join us next time. Thank you.